This video is brought to you by TogetherBudget.com. Let's dive into the world of mindset blocks, those invisible barriers that prevent us from achieving our financial goals. One common block is the fear of loss, which can cause us to play it too safe and miss out on potential gains. We've all been there. We're hesitant to invest in a new opportunity because what if it fails? But this fear can be paralyzing, causing us to miss out on opportunities that could lead to significant wealth creation. Another significant block is the fixed mindset, where we believe our abilities are innate and unchangeable. This can lead to a fixed focus on income rather than exploring new opportunities for wealth creation. We may also be stuck in a scarcity mentality, believing that there's never enough money or resources to go around. But what if I told you that these mindsets are not set in stone? By becoming aware of and challenging our thought patterns, we can break free from these limitations. The final block we'll explore is the over-reliance on guaranteed income sources. While having a steady paycheck can provide a sense of security, it can also lead to complacency and stagnation. We may be so focused on our day job that we neglect other opportunities for wealth creation, such as starting a side hustle or investing in dividend-paying stocks. But what if I told you that there's a way to break free from this cycle and start building multiple streams of income? When it comes to building multiple income streams, one of the most effective strategies is to diversify your investments. Real estate investing, for instance, can provide a steady stream of passive income through rental properties or real estate investment trusts, REITs. Stocks and bonds offer another avenue for generating returns, with the potential for long-term growth through compound interest. By spreading your investments across these asset classes, you can create a diversified portfolio that reduces risk and increases the likelihood of achieving financial freedom. Entrepreneurship is another powerful way to build multiple income streams. By creating your own products or services, you can tap into new markets and generate revenue beyond traditional employment. This might involve launching an online business, developing a mobile app, or even starting a small brick-and-mortar store. The key is to identify areas of passion and expertise, then leverage those strengths to create something unique and valuable. Of course, building multiple income streams requires more than just investing in traditional assets. It also demands a willingness to take calculated risks and adapt to changing market conditions. This might involve learning new skills, networking with other entrepreneurs, or experimenting with innovative business models. By embracing this mindset of continuous learning and improvement, you can stay ahead of the curve and build a robust financial foundation that will serve you well for years to come. One key aspect of maximizing tax-efficient wealth accumulation is understanding the power of tax loss harvesting. This strategy involves selling securities that have declined in value to realize losses, which can then be used to offset gains from other investments. By strategically implementing tax loss harvesting, individuals can minimize their tax liabilities and optimize their wealth growth. For instance, if an investor holds a portfolio with both winners and losers, they can sell the losing positions to book the losses and use them to offset gains from the winning positions. Another essential strategy for maximizing tax-efficient wealth accumulation is charitable giving. By donating to qualified charities, individuals can reduce their taxable income and create a more favorable tax environment. Charitable donations can be made in the form of cash, stocks, or other assets, providing flexibility for donors. Moreover, these donations can also provide benefits such as increased estate planning efficiency and reduced tax liabilities on inherited assets. Tax-efficient wealth accumulation also involves understanding the nuances of tax-deferred accounts such as 401(k)s, IRAs, and Roth IRAs. By contributing to these accounts, individuals can delay paying taxes on their earnings until retirement or later. Moreover, by strategically allocating investments within these accounts, individuals can optimize their returns and minimize taxes. For example, contributions to a Roth IRA are made with after-tax dollars, allowing for tax-free growth and withdrawals in retirement. When it comes to investing in assets that generate passive income, we're talking about creating a steady stream of revenue without having to be directly involved. Think of it like a rental property where the landlord collects rent from tenants. The investor doesn't have to physically show up every day to collect the money, it's all taken care of through various systems and processes. This is exactly what we want in our investment portfolio, a mix of assets that provide regular, predictable income without requiring direct involvement. Now, let's dive deeper into some of the most popular assets that generate passive income. Real estate investment trusts, REITs, are a great option for those who want to invest in real estate without directly managing properties. REITs pool money from investors and use it to purchase or finance properties, generating rental income. This can be an attractive option for those new to investing or who don't have the time or expertise to manage physical properties. Another key aspect of investing in assets that generate passive income is understanding the concept of compounding. Compounding occurs when interest earned on an investment earns additional interest, creating a snowball effect. This can lead to significant growth over time, especially with consistent and regular investments. By focusing on long-term growth rather than short-term gains, investors can create a powerful wealth-building machine that generates passive income without requiring direct involvement. High-net-worth individuals often employ a multifaceted approach to wealth building, incorporating a combination of strategic investments and smart financial management. They typically allocate a significant portion of their income towards long-term investments, such as dividend-paying stocks, real estate investment trusts, REITs, and index funds. Additionally, they prioritize tax optimization through tax-advantaged retirement accounts, charitable donations, and other creative strategies to minimize their taxable income. Another key strategy employed by high-net-worth individuals is the concept of time in the market versus timing the market. They understand that steady, consistent investments over time can lead to significant wealth accumulation, whereas trying to time the market through frequent buying and selling can be detrimental. This mindset shift requires discipline and patience, as it involves avoiding emotional decision-making and sticking to a well-planned investment strategy. High-net-worth individuals also recognize the importance of leveraging their skills and expertise to generate additional income streams. They often pursue side hustles, invest in businesses or real estate, or create intellectual property that can be monetized. This mindset shift involves thinking beyond traditional employment and embracing entrepreneurial spirit to supplement one's primary income. When it comes to retirement planning, one of the most common pitfalls is underestimating expenses. Many people assume that once they retire, their living costs will decrease significantly. However, this couldn't be further from the truth. In reality, retirees often face increased expenses related to healthcare, travel, and lifestyle adjustments. To avoid this pitfall, it's essential to create a realistic budget that accounts for these potential increases. This includes factoring in inflation, unexpected medical bills, and other miscellaneous costs that can add up quickly. Another critical planning consideration that's often overlooked is tax implications. Many retirees fail to optimize their tax strategy, leading to unnecessary losses in retirement income. This can be due to a lack of understanding about tax-deferred accounts, such as 401k or IRA, or failing to consider the tax consequences of withdrawal strategies. To avoid this pitfall, it's crucial to work with a financial advisor who can help you navigate these complexities and develop a tailored tax plan. Finally, one of the most significant mistakes retirees make is failing to account for inflation and market volatility. Many people assume that their investments will continue to grow steadily over time, but this isn't always the case. Inflation can erode purchasing power, while market downturns can reduce investment values. To avoid this pitfall, it's essential to diversify your portfolio, invest in assets with a history of inflation protection, and consider strategies like dollar cost averaging.